GKFX Prime presents the week ahead. Hi everyone, here's a riddle for you. Some people buy into it, but it's not a carat. It's a precious metal. That's pure 24 carat. Go ahead and reward yourself by clicking the like button if you guessed gold. So we've got the Federal Reserve meeting this week, and I'm focusing on gold because the extra money the Fed has been pouring into the financial system has been boosting demand for hard assets, not least gold. But the gold rally has stalled in the last 6 weeks, and I'll explain very shortly why I think the Fed meeting could be make or break. Before that, there are some other big data points to be aware of this week, which I will briefly run through now. First up, there's trade and FX reserves data out from China. Chinese exports will offer a good clue about the state of both China and the world's economic recovery in May. The official OPEC meeting is scheduled for Tuesday, but an earlier virtual meeting of the top producers, including Saudi Arabia and Russia, might make it unnecessary. We have inflation data out of the US and China before the FOMC meeting. Then one to watch for sterling is UK Q1 GDP on Friday. Now, what has drawn out all the gold bugs this year? In my view, it's been attractive to buy gold because the Fed has been buying bonds with printed dollars, and in the process driving yields, i.e. the interest rate you earn on bonds lower. A non-interest bearing asset like gold does better when rates drop. Actually, by the same logic, stocks become more attractive because the expected return on stocks will be that much greater than in bonds when bond yields fall. I think some of the reason gold has been taking a pause recently is that the minutes from the last meeting, the Fed said it expected the pace of Treasury bond and MBS purchases could be reduced since markets had been functioning properly recently. Added to that, Fed Chair Jerome Powell told Congress last month the Fed prepared not to use negative interest rates. Given that rates are now in a range of 0 to 0.25%, it seems unlikely rates will be cut further. So what else can the Fed change? Well, I think for this meeting, it comes down to forward guidance, meaning how will the Fed show markets what it plans next? There are two methods that could be introduced, outcome-based and time-based. Outcome means the Fed would commit to specific outcomes before tightening policy such as inflation and unemployment targets. Time would probably be done via the Summary of Economic Projections, or SEP for short. Normally the Fed releases the SEP 4 times a year, but didn't in March because of uncertainty. The bit to watch in the SEP is the dot plot, where Fed members predict short-term interest rates. In summary, if the Fed guides that policy will remain loose until full employment and its 2% inflation targets are met, or if it says rates are expected to be pinned to the ground for a long time, say until the year 2022, then those, in my view, should be positive forces for both gold and hard assets and riskier assets like stock markets. Otherwise, if markets come away unclear about what the Fed is planning next, that could call the end of the gold rally for now. Right, thanks everyone. Good luck trading and make sure to subscribe to our channel so you don't miss our next video.